In this part, we will explain in detail the following orders: stop order, limit order, and market order. Our first order is stop order. Stop order is mostly known in relation to the so-called breakout strategies. These are strategies where we open the position and we expect the price to break a price level. And when it does, it keeps going. It means that the market gets some energy here. The price is progressing, is shaping, and what we statistically found out is that when the energy gets to the concrete point and breaks a significant level, for example, monthly high, the price will keep on growing. And when our robot is set like this, it put the pending stop order in advance, and when the price reaches and breaks it, the position will be opened in the long direction. If we would want to open the position in a short direction, we would move this line here, somewhere here at the bottom. When it comes to these orders, it is interesting that most of the time they are held by broker servers. So if your platform would have some kind of outage, orders will be still there. But that's advantage and disadvantage at the same time. It's advantage when you use them for hedging or position closing, so the protection is right in the market. Disadvantage when the server breaks down or something like that, we can't manage the strategies, but orders are still there, so it is necessary to keep that in mind. But simply put, using stop orders, we break a price in out direction. So the line goes to the price and then continues further. Now let's talk about limit order. As you can see, our graph is a little bit different. The price was developing and shaping similarly, but after it reached the price level, we expected the price to bounce from the price level and will get back. It means that in this case, the short position will be opened. So the price was shaping and growing to the price level here, and it bounced back and short position was opened. Now just quickly compare long position and short position. So long position is in long direction up, and short position goes down. And then we have here market order. Again, the price is shaping here, but there's no level that it would have to reach, but there's the time of entering the order. So it means that here is a condition, one of the conditions that we showed you in the previous lesson. So for example, that it is 3 p.m. and when the condition is met, we enter the long or short position. Before we will move to AlgoWizard, we would like to explain you what is price level calculation. So the calculation of a concrete level in the market. We will need to understand that to use stop and limit orders. So let's just briefly explain it and then show it all in practice. And how does it even look? Well, the price level is any price, for example, close, open, high, low, just any market level price. And for the robots that we are building here, there is a kind of standard way to calculate price level for pre-dash break or for limit or bounce that goes most of the time like this. Price level, so indicator or price plus multiplier multiplied by ATR volatility deviation. The second part of this formula, multiplier multiplied by ATR volatility deviation, causes that if the price is more spread and dynamic, there is more volatility in the market. This number gets higher and is added to price level. It means that the price has to break through the higher level in case of higher volatility, and when the volatility increases, the level gets closer and closer to the price level. This formula works very well for almost all robots. So you will mostly see this formula while building your robots. And one more thing, if you would choose the exact price level, for example, highest, these levels are, in general, well known by everyone on the market, and very often there are false breakdowns. So the price gets to the level, touches the level, and gets back really quickly. After this, it continues again. And this formula can at least partially protect us from it. Because as we set the pending order a little bit higher, the price has to get there, breaks the level higher, and then continues. Also, here we have few examples. Daily close 1 plus 0.5 multiplied by ATR 14. So yesterday's closing price plus half of the ATR deviation, and because we get the deviation right from the graph, we have already normalized value. So when the value of tick or pip is changing, the ATR value will still match. Then we have here highest 20 plus 0.1 multiplied by ATR 14. We can use this for breakout, stop order, for long position. And then we have here lowest 20 minus 0.1 multiplied by ATR 14. And that's what we can use for stop order, for short position. Well, and now switch to AlgoWizard. The first order that we are going to talk about is going to be market order, because every strategy that we've shown you so far, except just one, contained this order. And our last strategy also contains it. So we are going to work now with a strategy from our last lesson. Market order is defined in long entry bookmark or tab. Here you can see action enter at market. And also in the bookmark short entry. Again, here you can see enter at market. Now we are going to define the bookmark long entry once more, so we could explain it step by step. To create new tab, click on add rule, and you can choose if then else, or action only. But in this case, I'm going to choose if then. Now you can see tab named rule 6, and let's set conditions that we have here in long entry tab into tab rule 6. So it's going to be long entry signal and not short entry signal, and not long exit signal. Click on add first condition, and long entry signal is Boolean variable. So go to other, choose Boolean variable and long entry signal. That's the first one. The second one, not short entry signal. You have to firstly go to comparisons, choose not, confirm it, and our value is again Boolean variable, and it's short entry signal. And let's add our third condition, not long exit signal. So in the same way, comparisons, not, confirm, value is Boolean variable, long exit signal, confirm. Now just briefly check it if it matches. So long entry signal, not short, not long exit. And you can see that it's the same like we have in a tab long entry. And just a quick reminder, the variable here is the source where we save the status of these conditions which we created before. If the condition is valid, there is true in long entry signal Boolean variable. If it is not valid, there is false. The same goes for long exit signal and also for short exit signal that we don't use because our strategy is only long based. So our conditions are long entry signal and not short entry signal and not long exit signal. And if these three conditions are valid, then is true. Now let's add the action. In our case, market order, open market. Click on add first action, go to order open, choose enter at market and confirm it. And now we have defined here our market order. So if these conditions are valid, then this action is triggered. In comparison to the stop orders, there is one difference. Here we have no price because we enter the market when conditions are met, not the price. Here you can choose direction, long or short. And if we would delete this tab, long entry, and substitute it with our tab named Rule 6, so we have to move it to the left side, and once more. Also let's rename it long entry, and run the backtest. The result is the same. Like this, we just add market order into the strategy. Now let's move on to another order, enter and stop. And let's start a new strategy. Choose a full wizard, but for this time, let's not choose the basic strategy template. Generally, we don't recommend using this option, but for now, it's going to be a good way to show everything what we need. And the first step is to define magic number in variables. So here, go to variables, click on add new, switch it on, name it magic number. It's integer type, so that's fine. And let's say our value is 1, 2, 3, 4, 5, 6. And you can close it. And now we are going to add our first step. So first rule, and it's gonna be if, then, and the rest of it is just fine. The interesting thing about the strategy that I'm gonna show you right now is the fact that there is just one input condition, and that's market position is flat. And that's all. Practically, it means that the strategy will always hold a pending order while the market is open. And our action is going to be enter at stop, confirm it. With the stop order, you can immediately see that it is necessary to fill in this value, so click on it, and I'm going to choose indicator highest, period 150. It means that the highest candlestick from the last 150 candlesticks, and we can compute it from high. Click on confirm. And because there is no exit rule, we have to define how we are going to exit the position. So far, when we exit the position using exit condition, when we exited a position, we used exit condition. But now we are going to exit using stop loss and profit target. Set profit target to 200 pips because it's futures, gold and not CFD, and stop loss also 200 pips. Now we have to choose the data, so go to settings and it's going to be MetaTrader 5 netted and symbol GCMT5. Select the time frame only and run full backtest. We can see here the strategy with a major slump. However, the curve is growing, but let's check out what else we can do. A part of enter at stop action is the exit method, exit after bars, which means that if the position is open when the price intersects the pending order, it should be closed after a fixed number of bars. And from our experiences, it takes about 12 hours. So let's try it and let's run full backtest now. And as you can see, it looks much better. But let's try another contraption. We have here move stop loss to break even. It means that in case the price reaches the profit in break even, it moves stop loss to a concrete level. So let's set here 20 and run full backtest again. Now the results are pretty smooth, right? Of course, it will be possible to optimize it more, but it's not our goal now, and also we don't want to ever overfit the strategy. So what I'm gonna do now is to explain other options we've got here. So SL to BE, stop loss to break even at pips. Using this, we can add some pips to this previous option, so it wouldn't be only the breakup price level. So it means when it's 0, we can add 2 pips here. And if we would run the backtest, the results are not gonna be so different. Then what I can use is trailing stop. It's kind of floating window which moves when we reach a concrete profit, and the price can be moving within the scope of this window. If we would set here these 50 pips, the window could move in the range of 50 pips. Let's try to run full backtest with this. And again, you can see it's a little bit more smoother. Well, like this, we build a simple stop strategy for long direction, and we've explained exit methods that we can use, and we also added a simple price level. Now let's take a look at the limit order. For this case, we used a strategy that was built in strategy Quant called pull back Cobra. So let me just load it. So it's here, and on this strategy we will describe how to add the limit order and how to set compounded price, so calculation of price level. The tab structure is the same as we already know it, so long entry, then short entry, long exit, and short exit. And we will focus on long entry, but as the first thing, let me show you how to add the limit order. So I created new tab, add first action, go to order open and choose enter at limit. So that's how we add it. I'm just going to delete it. And let's go back to the long entry tab, where almost everything is similar to the previous stop order. The only thing that differs is much more complex price level formula. And what I'm going to do is to delete it, and we are going to define it again together. When we define a more complicated price level like A plus B, before we even calculate value A or B, we have to define plus sign. click on value, and in functions, choose plus. And now you can see we have two sides, left and right. To evolve the left value even more, click on the left value and choose, for example, multiplication. And now you see how we put the formula together, how it works. The formula can be as complicated as you just want. But we are going to use just the left plus right value. So I'm going to delete the multiplication. And the left value is going to be daily high and shift 1. And our right value is going to be function multiplication. And on the left side, there is going to be number. And it's gonna be 0.9. Confirm it. And on the right side, there's gonna be MTATR, so average true range. And let's set period 330 and shift 2. Well, and like this, the formula is complete.